Today is part 3 of our series, Taxes in Retirement. In this episode, we look at the planning opportunity our couple, Bill and Janet, have to impact both themselves and their daughter. We dig into the potential impact of Roth IRA conversions. Evan and Nikki are here. This is Wealth Wednesday. Hello, welcome back to our weekly show, Wealth Wednesday. I'm Neil Watson, a financial planner here in Marietta, Ohio. Today, I am joined by Nikki Ludy, a financial planner in Woodsfield, Ohio, and Evan Brockmeyer, a financial advisor also in Marietta, Ohio. Parts 1 and 2 you can find on our YouTube channel as well as our website, and this is part 3. So Bill and Janet are retiring in 2024. They have about $750,000 in two 401k accounts, and they're going to depend on those and Social Security to generate their income. Today, we focused on the biggest planning opportunity they have, and that is Roth conversions. We all know that one of our beneficiaries for our retirement accounts is the government. And if you've used pre-tax contributions through the years to save for retirement, at some point, those assets are going to be taxed. So whether you pay the taxes or your kids do, the Roth conversion strategy is all about minimizing the government share. Nikki, one of the first things we have to understand is the basics of tax brackets and how to fill them up. Can you explain what we mean?
Yeah, so I find that, Neil, this is a big misconception when people talk about tax brackets. When you talk about filling them up, it's basically that everybody pays a portion at different percentages as their income increases. So once you get past the standard deduction, you're going to have a little bit paid at 10%, depending on your income, a little bit at 12%, a little bit at 22% if you get up into that bracket, and a little bit up to 35%. So unlike what most people think, how this system works is once you get $1 over one of the brackets, it does not put all of your income into that tax bracket. So even though there are these marginal rates, your effective tax rate, even if you're in the 15% bracket, maybe closer to that 10% range, depending on how far into that bracket you are. So let's look at Bill and Janet's situation of how they can fill up their income brackets. So the first is inside of our planning software, we can differentiate which bracket and when they cross over into each of those brackets as they generate enough income to reach the next level. So the orange line represents the next tax bracket. So as their income increases, we can tell that there's an additional $45,000 to $50,000 worth of income that would move them up into that 22% bracket.
So Evan, last week we illustrated what happens when their daughter Barbie inherits these IRA accounts remaining. She inherited roughly $500,000 when her mother died. And because Barbie is working, her husband Ken is also working, they're already at a point where each additional dollar of income is going to be taxed at 24%. So why does this make looking into those Roth conversions worth considering?
Yeah, this is one of those cases where it's always important to examine the whole picture. We don't ask what the kids are up to just to make small talk. This is an example of why that's important. So in this example specifically with Bill and Janet, they have the opportunity to keep the taxation of the accounts, not necessarily just to themselves, but the account as a whole at a much smaller rate. So again, the point here is to convert the 401k that has yet to be taxed to a Roth account and paying the least amount of tax possible, both in their lifetime and for Barbie and Ken together. So in this chart, the yellow bars are the taxable portion of their Roth conversions. And that's how our software illustrates filling up that tax bracket.
So Nikki, this isn't necessarily a slam dunk thing to do. There are a lot of things to consider, and we're trying to keep this as simple as possible. Tell us what we're looking at here on these next charts.
Right. So the first thing is obviously Bill and Janet are going to pay some taxes. Their cumulative tax without doing the Roth conversions is going to be approximately $77,884, with portfolio assets remaining of $597,000 roughly. But that doesn't really tell the whole story because all of that needs to be taxed whenever Ken and Barbie inherit these assets. So our second chart shows what is being estimated to be transferred to Ken and Barbie, which again, after taxes, because Ken and Barbie are at a higher tax bracket, they're going to end up over a 10-year period of paying approximately $170,000. So the net to them after the taxes are paid is only about $427,000. So again, as Neil said, $170,000 is going to your favorite charity called the IRS. So again, it's because Ken and Barbie are at this is assuming a 24% federal tax bracket for Ken and Barbie, as well as a 6% state. So a lot of that is eaten up by taxes. And so if Bill and Janet are to do the Roth conversion, even though they would pay more in taxes, they would end up paying approximately $130,000 over that 10-year period for taxes, which is about $52,000 more than they would without the Roth conversion. That would take the portfolio assets up to $456,838. So it would actually net the heirs more money by doing this. It's going to cost them a little bit more in taxes, but obviously not quite as much as it would to Ken and Barbie. So it gets them, it costs Bill and Janet a little bit more money, but gets their daughter more money. And because it's now in the Roth category, they're not paying any taxes once they inherit that. Which is, again, if the ultimate goal is to pass this along, and again, if they're in a higher income tax bracket than what Bill and Janet are, then this is definitely going to net the heirs more money, almost $30,000 more in an inheritance, and a generational tax savings of almost $40,000. So again, the difference in those tax brackets make all the difference in this situation.
This is a great way to illustrate the impact of this, Evan. And we've gone through some of these situations with clients. What are some of the key things that you need to be aware of when you're evaluating these Roth conversions?
Yeah, I think there's a few key points here to consider. One is the tax payments themselves. So can you, in this case, Bill and Janet, can they afford to pay them themselves? So you're not sacrificing your own needs. And being able to pay them from other sources other than the account that you're converting, because that ultimately changes the math. Two is the who. So in this case, if it's the kids who are going to inherit it, then what's their income? What's their tax bracket? And if they're being taxed at the same rate as the account holder, then this doesn't work out as well. But if the who is a charity, then this might not be the best strategy, because the organization may not have to pay taxes on that anyway. So there's considerations there. And then the third is timing. So, and this could be many things, but the biggest piece is hitting the sweet spot for doing conversions. And that's normally between retirement time and when RMDs start. So that's typically when the income's the lowest and you get the greatest bang for the buck, if you will, here. So also important to know, in Janet's case, if Bill were to pass away, then she would switch to a tax bracket that would be less beneficial to her. So it's important to get these done, while they're both still healthy and living. So main takeaway here is we need to analyze this from a multi-generational standpoint, not just as things stand today, but over the course of time. And I know that can be challenging for clients to do, but it's ultimately trying to minimize the tax impact over the lifetime of the account, not just the account holders themselves.
Yeah, and I know as we've dug through a lot of these with clients, this is really an interesting opportunity to consider evaluating. And if there's something here that interests you and that you'd like to look at it a little more deeply, please reach out to one of our advisors. You can contact Nikki, Evan, or myself at our website, that's CFSWV. And just a reminder, everything that we've shown is kind of a simplified example just to illustrate a point. It's not an actual person that we're looking at. We'd like to thank everybody for watching. And if you have any questions, please reach out to us. We'd be happy to help you out and analyze your situation. Thanks for watching. Have a great week.